Today we're going to look at tax losses from people who have been duped in Ponzi schemes, where they invest money, they think they're going to get big returns, and there is really no money there. It's a false investment. The promoters keep sending out statements saying, look at how much money you made, but it's really money that the new people are putting in is getting paid out to the old people, and there really is no investment. There's no business. There's no real serious economic investment. Ponzi schemes provide people with a very, very good tax loss. And the refunds can be as large as 50 and 60%. If you're in a state that has a federal income tax, which they all do, and then a city income tax and a state income tax, and you're in a high tax bracket, you can actually take a deduction for Ponzi scheme losses and receive 55 or 60% back on your money, because that's the taxes that you paid in the beginning. So it's a very good thing to pay attention to. Now, tax refunds from Ponzi schemes as I said, they're very valuable, and you can have all of the income that you lose, you get an ordinary loss for. That's in the highest tax bracket. You can carry that loss back 3 years, because Ponzi schemes are considered to be theft losses. And theft losses allow you to have a 3-year carryback, and you can carry the losses forward. If you don't use them up in the year of loss or in the 3 years that you go back, you can carry them forward 20 years. It's a pretty fast process insofar as IRS is concerned, because they get to the heart of it quickly, and you've got your most secure payer, who's the United States of America. And at times, if the IRS is late in giving you your refunds back, you can actually make some money, make interest money on the refunds. So the Ponzi scheme is a particular kind of theft loss. They call it a theft loss that's when you're engaged in a trade or business, or you're trying to make a profit. That's why you get the ordinary losses. The amount of your Ponzi scheme loss is calculated on 3 different amounts. First, what you invested. Second, what you thought you made, where the promoter says you invested $100,000, you made $10,000 this year. You have to pay tax on that $10,000, and if you don't take that money out and leave it there, that adds to your theft loss. In order to take your theft loss, there has to be a theft. There has to be a criminal action. Now, there doesn't have to be an indictment, but there does have to be, under the law of whatever state you're in, that particular false investment would fall under the criminal statutes. Now, the other thing that you need to pay attention to in the Ponzi scheme is, when can I take my loss? And you don't take your loss in the year of the theft, or any of the years of the theft. You take the loss when you finally discover that there has been a theft. In that particular year, you will add up all of your investments, all of the funds you've paid taxes on. If you've had any cash come out, you have to deduct that from your losses. And you can then take that loss in that particular year when the theft was discovered. Now, sometimes you can't take the entire loss in the year that you've discovered it. And that's because in many Ponzi schemes, there's a potential to have a recovery of funds from insurance or even from the perpetrators may be paying money back. So you're only allowed to take in the year that you have discovered your loss, the amount of the loss, and subtracting from that any amounts that you might get in the future as recovery. So you have to look at what's the reasonable prospect of recovery. And if you have a $10,000 loss, like in my example, but you're going to get from an insurance policy $25,000, then the only amount of loss that you can take is an $85,000 loss because you're going to get it in the future. Now, the Ponzi scheme allows you to ultimately take your entire loss. So if you, in the year of discovery, if you only have a reasonable prospect and the loss is $85,000, and you find out that you really did lose a whole $110,000, you're allowed to take that other $25,000 when you have determined with a reasonable certainty that you're never going to get it back.